Powell signals rate cuts aren't working. Is the Fed out of options? This is Macro Matters, and we're talking about the Feds. The chair of the US Central Bank, Jerome Powell, just threw markets a curveball. He's signalling a December rate cut isn't guaranteed. But even more eye-opening, he suggested that rate cuts may not fix the labour market. This job slowdown isn't about weak demand, it's due to a shrinking supply. So if cutting rates won't solve the jobs crunch, what will? Let's ask Jeff Schulze, Head of Economic and Market Strategy at ClearBridge Investments. So Jeff, this week's cut came even as Powell showed little concern over price pressures. Some analysts think that the inflation target has quietly risen to 3%. Is higher inflation the new norm?
I think it is the new norm, at least over the next couple of years. Powell did throw a little bit of cold water on that December rate cut. There does appear to be a wide array of opinions on what monetary policy should be going forward. But ultimately, I do think that the risks are greater to the labor market than to the inflation picture. When you dissect the latest CPI release that we got last week, core goods inflation is still positive at about 0.2% on a month-over-month basis. And that pass-through is much less aggressive than what we had anticipated 6 months ago with the announcement of those Liberation Day tariffs. And Powell himself even mentioned that inflation is a little sticky, but the increase that we're seeing right now is primarily related to tariffs. So as we look out to that December rate cut, although there is a wide array of views on what the path of monetary policy should be going forward, I see the FOMC cutting in December and then taking a pause to reassess activity going forward.
Well, let's look at the labour market side, and slowdown is largely a supply problem, as Powell says. Then cutting rates may have limited impact. Is a longer pause now on the cards?
Well, I think a longer pause, at least for monetary policy, is in the cards after we get that December rate cut. But when it comes to the labor market, the U.S. has been in a very weak labor market for the entirety of 2025. A lot of that is labor supply, as you mentioned, with lower immigration. But I think importantly, as you look out to 2026, I see a more robust labor market than what we currently have, because right now we have a policy mix that you only see coming out of recessions. You have the Fed that's cutting, and you have the peak fiscal impulse of the one big beautiful bill hitting in the first half of next year. And when you layer on top of that more certainty on the trade front, I think that creates a pretty strong dynamic for hiring to firm up in 2026. But I think going forward, sub 100,000 jobs creation per month should be the norm, but that is more than enough to keep this expansion and this market moving higher.
Well, Powell also noted that there's no broad-based deterioration in the labour markets, yet some headlines we've seen this week, some high-profile layoffs with the big tech companies. Could AI be creating new pressures in the job market?
Well, it is creating some dislocations, and you do see this with new technological advances throughout time. But ultimately, I think that the labor market is going to be relatively robust next year because of that dynamic that I talked about earlier, that policy mix. But I think more importantly, when you look at earnings delivery, profits are moving higher throughout the U.S. economy, and that usually coincides with strong labor creation. Now, maybe a little bit less than what we've had over the last couple of years, but nothing that would suggest that you're going to see a more pronounced labor cycle to the downside.
Goldman Sachs now warning that the mounting debt could trigger a reckoning if growth stalls. Meanwhile, the shutdown has already cost the economy $18 billion. Should the Fed be worried if this persists?
Well, the longer that this shutdown does persist, you do steal a little bit from fourth quarter GDP, but we will see a little bit of that come back when government reopens and you get that first quarter GDP number. But ultimately, because of that policy mix that I talked about earlier, we are expecting a very robust economy next year, and we think AI investment will continue to be strong, which is just another tailwind for optimism on the economic front.
Powell as well said he isn't losing any sleep over bubble risks. But after all the hyperscaler earnings this week, do you agree?
We're not at bubble territory quite yet. When you look at the hyperscaler earnings delivery, it was quite strong across the board. You saw Azure numbers come in above consensus expectations. You saw Google Cloud come in at above 30% of a growth rate on a year-over-year basis. So earnings delivery is quite strong, especially with Amazon and Apple's release last night. But we could get to bubble territory. I think that is a couple of years off from now. And ultimately, I think the positive development that we got from this week and those earnings is that CapEx is going to continue to be strong, which is going to support S&P 500 earnings, but also, as I mentioned a second ago, the U.S. economy.
So finally, Jeff, historically, equities have done well when the Fed cuts rates, but does that scenario fall apart if the Fed takes that longer pause that you're suggesting?
It doesn't. When you go back to 1980 and you look at all 75 basis point rate cutting cycles or greater, and you bracket them into soft landings and recessions, when you have a soft landing cutting cycle, the S&P 500 continues to move higher as you look out over the next 2 years. In fact, when you look at the 3 soft landing cutting cycles that we can point to, over the next 2 years, the S&P 500 has cumulatively delivered 48% returns. So although the markets are pricing in a lot of optimism for next year, we see more upside. And if we do see any volatility or correction in the S&P 500, we're firmly in the buy the dip camp.
That was Jeff Schulze from ClearBridge Investments. Don't forget, you can watch more videos on Reuters.com.